There is a building in Washington, D.C. that most Americans walk past without a second thought. Its marble columns and iron gates suggest permanence, authority, and stability. But behind those walls operates one of the most powerful and least understood institutions in human history, the Federal Reserve. It controls the money supply of the most dominant economy on Earth, sets interest rates that ripple through every mortgage, every business loan, every savings account in the country, and yet most people cannot explain who runs it, who owns it, or how it actually makes decisions. That gap between the Federal Reserve's enormous power and the public's understanding of it is not accidental. It is, in many ways, by design. To understand the Federal Reserve, you have to go back to a cold November night in 1910, when a group of powerful men boarded a private train car in New Jersey under assumed names. They were heading to Jekyll Island, a private retreat off the coast of Georgia, and they did not want anyone to know they were meeting. Among them were Senator Nelson Aldrich, a close associate of J.P. Morgan, Frank Vanderlip of National City Bank, Henry Davison, a senior partner at Morgan's firm, and Paul Warburg, a representative of the European banking dynasty Kuhn, Loeb and Company. These were not government officials gathering to serve the public interest. These were bankers, and they were designing what would become the Federal Reserve System. The meeting lasted 9 days. What emerged from Jekyll Island was a framework for a central banking system that would be presented to Congress not as a banker's plan, but as a reform measure to protect ordinary Americans from financial panics. The panic of 1907 had shaken public confidence in the banking system, and politicians were under pressure to act. The bankers understood that if they proposed a central bank outright, the public would reject it. Central banks were associated with European elitism and concentrated power, so they repackaged the idea. They called it the Federal Reserve, a name carefully chosen to sound governmental and distributed rather than private and centralized. The Federal Reserve Act was signed into law by President Woodrow Wilson on December 23, 1913. Wilson himself would later express deep regret, writing that he had unwittingly ruined his country by handing control of credit to a small group of dominant men. Whether that quote is entirely accurate in its attribution remains debated, but the sentiment it captures reflects a tension that has never fully disappeared. The question of who actually owns the Federal Reserve is one that sounds simple but has a layered answer. Technically, the Federal Reserve System is composed of 12 regional Federal Reserve banks, and those banks are owned by member commercial banks within their districts. When a commercial bank joins the Federal Reserve System, it is required to purchase stock in its regional Federal Reserve Bank equal to 6% of its capital and surplus. So in a literal legal sense, private commercial banks own shares in the Federal Reserve banks. But here is where the architecture becomes deliberately complex. Owning stock in a Federal Reserve Bank does not work like owning stock in a corporation. Member banks receive a fixed annual dividend of 6% on their shares, a rate that was actually capped and modified by legislation in 2015. They cannot sell those shares or use them as collateral. And critically, they do not control monetary policy. The real power within the Federal Reserve System sits with the Board of Governors, a 7-member body based in Washington, D.C., whose members are appointed by the President of the United States and confirmed by the Senate. This board oversees the entire system, and along with 5 of the 12 regional bank presidents, forms the Federal Open Market Committee, which is the body that actually sets interest rates and determines the direction of monetary policy. So the Federal Reserve exists in a strange hybrid space, partially private in its ownership structure, partially public in its governance. It is not a government agency in the traditional sense, but it is not a purely private institution either. It operates in a legal grey zone that its architects specifically engineered to insulate it from both political pressure and public accountability. That insulation is called independence, and it is fiercely defended by economists and central bankers who argue that monetary policy must be shielded from short-term political thinking. But independence also means operating beyond the reach of democratic oversight in ways that would be unacceptable for almost any other institution wielding comparable power. Understanding how the Federal Reserve actually operates requires understanding how money is created. When the Federal Reserve wants to stimulate the economy, it does not print physical cash and distribute it. Instead, it buys financial assets, primarily government bonds, from banks. It pays for those bonds by simply crediting the bank's reserve accounts with newly created digital dollars. Those dollars did not exist before the transaction. They were created from nothing, backed by the authority of the institution itself. This process, known as open market operations, is the primary mechanism through which the money supply expands and contracts. When the Federal Reserve buys bonds, money flows into the system. When it sells bonds, money is pulled back out. The interest rate the Federal Reserve sets, known as the federal funds rate, determines how cheaply or expensively banks can borrow from each other overnight, which in turn influences every other interest rate across the economy. Raise that rate, and borrowing becomes more expensive, spending slows, inflation cools. Lower it, and credit becomes cheap, investment accelerates, and economic activity picks up. These decisions affect every person who carries a credit card balance, every family paying a mortgage, every small business seeking a loan. And they are made by a committee that holds no public elections, faces no direct voter accountability, and operates with a level of transparency that, while improved since the 1970s, still falls well short of what most democratic institutions provide. The Federal Reserve's annual budget is not approved by Congress. Its operations are funded through the interest it earns on the assets it holds, and after covering its expenses, it remits the remainder to the Treasury. In 2022, however, the Federal Reserve actually recorded an operating loss for the first time in decades, raising questions about what happens when the institution that backstops the financial system itself runs into financial difficulty. The answer, buried in accounting rules, is that the Federal Reserve simply carries a deferred asset on its books and continues operating, a privilege no ordinary institution or individual enjoys. The people who sit on the Board of Governors are accomplished economists and financial professionals, and most of them take their responsibilities seriously. But the structure they operate within was not designed primarily with public accountability in mind. It was designed to be stable, insulated, and efficient, qualities that serve the financial system well, but leave ordinary citizens with almost no meaningful way to influence decisions that shape the value of every dollar they earn, save, and spend. The Federal Reserve is not a conspiracy. It is something more mundane and in some ways more troubling, an institution whose enormous power was deliberately placed beyond the reach of the people most affected by it, justified by the belief that experts should manage money and markets without interference from democracy itself.